Well, good morning, folks. Sorry for the short delay. I've been fighting an eyelash. I had to get an eyelash out of my left eye, and it still feels like it's there. So hopefully it stops bothering me here. So welcome. Good morning. It is a good morning. It is a good morning. So we're looking at the economic calendar, or should be. You should be seeing it, rather. The forex factory calendar is pretty loaded this week here. I added the euro and pound news drivers for this week because for the next hour or so, we'll be talking specifically about forex. So if you're not into forex, come back in about an hour or so. We'll be transitioning back to index futures. But if you're here to learn and want to take away some added insights about reading price, it's the same things whether you apply it to forex or futures, commodities, bonds, what have you. But I know you guys have been going through some withdrawals because I haven't touched on forex for a while, so we'll look at that for a little bit. But take a look at the economic calendar here for a second for today. All right, so at 8:30, we should see some fireworks, some volatility. And then towards the lunch hour, I'll leave you some comments about what I think the PM session may or may not do, since I won't be here with you. And then we'll be back at it again for our final portion of this workshop for this week, tomorrow at 8 a.m., where we will focus primarily back to just stock index futures. So forex is only going to be touched on today. Okay, I know, boo hiss. So we're going to take a look at the trading view. All right, and don't gasp. That's not an indicator. That's the dollar index overlay. But give me a second here. Let me get the screen maximized. ICT's got an indicator on his chart. Yeah, open, high, low, and close. The upper left-hand corner, let me make sure you guys should be hearing me okay. So, all right. So we have the upper left-hand corner chart. That is the dollar index at the 15-minute time frame. The lower left-hand corner is the British pound. That's a 15-minute time frame. I draw forex.com's data. That's the one I always use, and you can see that in the mentorship videos. If you've been a student of mine for any length of time, you know that that's the data I use. I don't use Oanda. I don't use any other type of brokerage firm. That's the one I use, so that way everybody has the same data. And obviously the larger chart here is euro dollar. The chart here, or oscillating line down here, is just simply the dollar index plotted as an overlay or compare. And you do that by clicking on this little tab, compare and add. When you click on that, dollar, and then if you want it to act like an indicator, plot it underneath your chart, which is what I advise. You click on new pane. And when you do that, it populates the chart down here. So the settings I have at present, it's plotted on the low. Okay, so what I'm showing is the relationship to where the lowest low of each interval. And since we're looking at a 1 hour chart here for euro, at the present, it's basically plotting it on the low of every hourly duration. And same things over here. It's just this smaller chart. So I kind of want to talk a little bit about what we mentioned yesterday with the dollar index. I'm going to maximize the chart just for a moment. And we're going to take us back up to a weekly chart. So everything is as it was explained yesterday. So we have this, actually monthly, because I want you to see again where that big blue range is delineated. from here on this CIBI, okay? And then back down into the weekly chart. We mentioned in this area here, based on the equilibrium and or consequent encroachment of the subsequent ranges that we mentioned yesterday, so I don't want to repeat all that. In here, we talked about how this candle's high, that candle's low, gives us a buy sign and balance, sell sign and efficiency. I did not color it because I wanted you to see the consequent encroachment of it, which is here. And then this range, this inefficiency there, that will be found on the daily chart. And that's this one here, okay? So we covered all that yesterday, and I want you to take a look at how this daily buy side and balance, sell side and efficiency, which is this particular candle, how it behaved intraday. Okay, I mentioned how we could see a little bit of a give back in the dollar index yesterday. We got that. And longer term, I expect them to try to work towards buy side this week on all the reports. If you missed it yesterday, because I saw a bunch of people leaving posts and comments, was I saying that we're trying to trade with a bias or without a bias this week? If you listened to the recording yesterday during the live stream, and you can go back and watch it now, the premise was we are to trade without a bias. But gun to my head, I have to tell you what I believe. What I believe is going to be the draw. Okay, so because it's a Monday, Tuesday, Wednesday draw on liquidity, I'm submitting to the likelihood that it could have been yesterday, it could be today, or by noontime, or maybe it's the reaction off of the rate announcement, tomorrow afternoon. At either end of the spectrum, we're not trying to trade with a daily bias where we're trying to get the known bias in a week like we have this week. It's too many high impact news drivers. It's non-farm payroll. There's just way too many things to try to adhere to or hold yourself to the flames of, I have to know the daily bias in the direction of the day. You don't need that. And that was the whole point of communicating what I did as much as I did in the beginning of the live stream yesterday. We don't need a bias. Okay, and that's primarily what we're going to be focusing on today. Okay, so I'll be doing that with forex for the first hour, and then we're going to go into stock index futures, and again, without a bias. So we're going to be reading price off the cuff using just intraday volatility. That's it. Liquidity, inefficiencies, those types of things. Last bit of preamble. It is not an invitation for you to avoid trying to learn how to find a bias. Because if you can focus there, that skill set will serve you well. It'll also filter out a lot of losing trades. But while you're practicing and you're tape reading, you're going to be able to use a lot of the things I teach today and what I taught yesterday. So anyway, the low of the buy sign and balance, sell sign and efficiency, which is this particular candle here on the daily chart for the dollar, that candle's high is the low that's being highlighted here. And you can see how we just went out of it by wicks only, and the bodies are staying within it. So let's go into intraday price action. Okay, you can see how we wicked outside of here, and now we're starting a new day. And in the 15-minute time frame, right here. See that? The bodies were just outside of the range there. We wicked outside of it there, but yesterday during trading, the low and the close of that candle is right on the low of that shaded area that makes the daily fair value gap. We opened on the same price and went higher. So we wicked outside of it because the wicks can do that exaggerated price run. It can color outside the lines. This is the number one reason why, because I still get people asking me, why do you speak against individuals trying to trade with a 2 pip stop loss? Well, if you're trading with a funded account and your stops are really not in the market because they're all demo, that you might be able to skirt around things like that. Maybe I'm not convinced that that's entirely true, but the fact that the markets can have a widening of the spread and your broker is going to have a different low than most every other broker if you're trading forex. So that's a built-in disadvantage to trading forex. Whereas if you're trading futures, everybody has the same low, everyone has the same high, and it's a gentleman's market. Whereas forex it's the wild wild west. You know, you're in there gunslinging with a broker that will absolutely try to cannibalize you, and you give them permission when you sign the documents to open up the account. So when it's advantageous for them to open the spread to take you out of your trade and liquidate you, they will. Okay, so and unfortunately, you gave them the permission when you open up your account. But look at the bodies telling you exactly what I teach, that the underlying narrative is derived from knowing how to read price, the inefficiencies, liquidity, market structure, order blocks, every other PD array, how they all support one another and they come together like a beautiful tapestry when you know what you're looking for. By themselves, you know, we talked about this yesterday, there's no real advantage to any one individual PD array. And a PD array is, you know, something like an order block, a fair value gap, a institutional order flow entry drill, a long list of things I've already mentioned in other videos. But this right here indicates that we have turned the corner, and now if it's going to go from the low end of that fair value gap, where is buy side? Where are the inefficiencies in terms of a premium? We have this high to that low. Right away we have this inefficiency, we have this inefficiency, we have this inefficiency, and then the buy stops resting above here, and that's high probability draw on liquidity, because watch, over here we have this. All of this is open. All that right there is open. So once we start to trade higher, you want to look at how down close candles should be supporting price advancing higher. We moved, bodies stayed within the context of that daily fair value gap. The market trades up, we have a down close candle. Does the price come back down to it eventually? And does it support price going higher? The high of that candle comes in at, you're going to be looking up here. The high of that candle is 105.58. The low in this candle is 105.577. So did it hit that level there and reverse or show willingness to act like a trampoline and rally higher? Yes. Now we have these two down close candles here. This is one consecutive order block. Why is it an order block? Because we are in the lower half of the range between that high and that low. So if we trade above it and come back down into it, it should support just like a trampoline. If it trades down to it, does it support a move higher? And do we see price moving higher towards a higher inefficiency, which would be here, and or buy stops? There's a small little short-term minor buy side liquidity pull here because we have a candle high, higher high, lower high. So that's a swing high. So there's going to be trailed stop losses right there. And that's usually a big mistake, especially when it's coupled with an inefficiency just to the left of it. And then you have the buy stops that will be resting over here. The market capitalizes on the order block here, moves higher. We have a small little gap between this candle and that candle. So there's your fair value gap. Trades down into it there. Does it have a willingness to trade higher? Yes. Consolidation, down close candle. It moves outside of the the down close candle. Does it trade back down into it? Yes. Does it act like a trampoline, send price higher? Yes. So we bridged this inefficiency. We patched over basically all the sell side with buy side. See the acceleration in price action right there? That's occurring because you have this. All of this sell side delivery. Remember I taught you yesterday. Sell side delivery is expansion or one directional move lower. Buy side delivery is expansion or one-sided upward, or buy side delivery or advancing expansion move higher in price. Just basically it's directionally driven. and it's offering buy side. It's offering it to the market. What do I mean by offering it? Well, if the market does want to gravitate to an old high or relatively equal highs, why is it going there? The algorithm's repricing to that level to offer the buy side. To who? The smart money. That's the way the system works. If you think like smart money, like I'm teaching you, you'll engage price that way. But most people, and I'm, I've been on the record for decades now, teaching and showcasing and proving that these things are absolutely here. But you'll still see a lot of people, and some of you probably listening still don't want to admit that, there is some kind of artificial intelligence that's running things, and it runs very efficient, but it's going to these buy stops in order to offer buy side to smart money. And they will what? They will offset distribute their long positions to willing buyers at a higher price. Where did they buy? Here, there, 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 there. This is institutional order flow entry drill. This is for your notes too. Whenever you're in a buy program, what's a buy program? A buy program is where price is going to be one-sided. It's in the process of running to buy side liquidity or a obvious premium inefficiency, which would be this, okay? Or the stops resting above here. Once we cross equilibrium, and now we enter into what? It's a premium market. But at equilibrium, while we're in a buy program or when we're bullish, it acts as a discount. So on your notes, if you missed it yesterday, I've said it in other places when I taught, when you are trading in a range, equilibrium, when bullish, is a discount. Equilibrium, when bearish, is a premium. So I mentioned yesterday, we were looking at this fair value gap. I mentioned how we could drop down a little bit. It stayed within the context of that daily fair value gap. Then we started moving higher. Higher. New day opening gap. Equilibrium is this level right here. We have a down close candle. Close proximity to that, that means yes, this can be an order block to be traded to. You do not look at these down close candles as an order block. It's not. They are not a bullish order block. ICT, why don't you look at that down close candle or those series of down close candles, and why didn't you look at that as a potential for the trade down to and create it as a order block? I just taught it to you. It's relative to the dealing range you're trading in. What's the dealing range? The high and the low. Why is that a dealing range? Because I taught you on April 8th of 2024's live stream that a dealing range is when both sides of the liquidity is taken. What's above this high here? Buy stops. It went above it and then traded lower. Where did this low go to? Just below that low right there. So what did it do? It took both sides of the liquidity. Do you see how the rules keep repeating? Nothing's being reinvented. I'm not manipulating and distorting anything. It's always remaining constant. But you don't want to be looking at down close candles that are in a premium level above equilibrium. This order block returned back to the equilibrium level or 50% mark of the high and the low of that dealing range. So when it trades above it, yes, we are looking for that to support price. But now watch what takes place. Any down close candle after that, we don't care about referring to it as an order block because we're now in a premium. We don't want to add anything. Remember I was teaching you yesterday? If I'm pyramiding a position, I'm building it into a larger position. Once I get to a point where I have basically 60% of the position, or not position, but the potential unrealized range or target for the trade I'm trying to be a participant in, I stop adding. The hard line rule is once we get into a premium level at equilibrium or higher, I don't want to add anymore. For my own personal tastes, I do it just below equilibrium and I'll stop adding. But the hard line rules are you can do it at equilibrium. But once we go above, if we have any situation like this, don't look at any down close candles once we're in a premium in a buy program where the market is predisposed to go higher to take out any inefficiency that's a premium level. This is premium because it's above equilibrium. So if you look at this is the high and this is the low. This inefficiency is where? It's in a discount. It's below the 50%. So that's not a target. So what is it? What is that right there? What is this right here? It's a sell side imbalance, buy side inefficiency. Yes. Basically, it's a down close candle that represents a fair value gap. We are not looking at that as let's get up into that and sell off to take out the relative equal lows down here. That's where people that watch the 5-minute trainer editions where individuals come, they sample set my content, and they cherry pick some things and they rename something, or they think it's a 5-minute ICT trainer. I'm going to teach you learn ICT in 5 minutes, learn ICT in 1 hour. That's why they don't do well. Okay, and I advise people not to do that, not to kick sand in their face, not to hate on them, but you're doing it wrong. And that's number one reason why there's a small group of people that think this stuff doesn't work, because they watch yahoos out there that don't know what they're talking about try to teach it in a way that doesn't line up with what me as the creator intended for you to learn. So if this SIBI, which is a fair value gap, sell side imbalance, buy side inefficiency, if it's part of the sell side of the curve, this right here, once we cross over there, this becomes an inversion fair value gap. Light bulb moment, right? Oh my goodness, it's starting to make sense. So if we look at it like this, see how the down close candle goes right into the old inefficiency. Everything part of a market maker buy model, because that's what this is, has to match up with the sell side of the curve. Sell side of the curve is, when a market maker buy model, it's the initial down run. And then the market claws its way back up to clear out the original consolidation and go above it where the buy stops are going to be resting. So you use all these things like a rock climber does. Okay, if you ever watched a rock climber, and I've used this analogy before, when they go up to a surface of a rock or a cliff, they look at it and they see where they're going to grab, where they're going to use for a foothold, and they can do it in a minute or so. They can already plan their route, and they've never been on that rock surface before. How do they know that they can trust their plan of ascension? How do they know that they can trust that? Experience. See, when you're looking at this rock surface or this cliff of price action from this high down to that low, my mind is, okay, we're going to need to use this, we're going to need to use that, we're going to need to use that, and the zenith, to get to the top of it, is here. That's my goal. But all of these price points here are footholds. I'm going to wait once I get to these areas where I can grab on to something that gets me into this vicinity where I can place my foot under that. Then I'm going to wait for a new handhold, a little area where I can put my hand on it and then pull myself up to get into this area. So these are all known. They're static. They can't hide them from you. So when you know that, you can take the very casual approach to seeing, oh, well, this is where I want to focus. And when price does in fact get above it, like a rock climber, they're going to want to use it as a foothold. And they climb up above it. Another foothold. Climb up into this area here. Foothold. Same thing here. This is not support and resistance, folks. As much as they want to call it that, you'll never see this in any classic support and resistance theory. This is all me. This is all coded. It's all algorithmically designed. This run here, look how it completely shoots up and re-delivers all of the sell side delivery here, all these expansive candles that are down closed. That thin price action, real quick, sudden movement lower, it's replicated with the movement up. What does that tell you? That's a signature that you are absolutely going to see the buy side get hit. That's designed to be there. It gives smart money. You're going to probably hear a little bit of sound in the background. I apologize. I'm in my office today, and the vent with the air conditioner is going to probably compete with me. Don't write comments complaining about it, because all I do is ban you. I don't want to see you bitching and complaining. And don't ask me for more breaks, okay? If you can't pause or come back and rewind the video or watch it later on, that's on you. I'm not going to slow down my roll because you can't keep up. It's recorded after all. But this quick delivery and price action, that matches the quick delivery price action on the downside. So when I'm talking about I want to see certain signatures in price action, that's a signature. Just like I want to see when price starts to rally, every down close candle that offers a fair value gap, if you're in a buy program, you are not thinking, oh, I'm going to go up here and sell short into that, or I'm going to go and sell short into that, or it's going to go up to here and then I'm going to sell short into that. You see how you have to have an understanding of the higher time frame. You have to flesh out a narrative why price should behave a certain way. And that's the reason why you're not going to get these 5-minute trainers out there. These guys that are trying to make these revamped versions of what I taught, because they want ad revenue, they want attention, they want clout, but they're not able to do it. They're not able to explain it properly because you're getting it for the first time here too, and it's for free. I want you to learn how to do it. I want you to learn how to do it well. So you can see how once we got through it, both fast movement lower, fast movement higher, down. Look at the bodies respecting what? What is it respecting? The inefficiency. There's no support resistance there. It's the fact that that inefficiency is being referred to by the algorithm. So now it will do what? It will then run from there to go to the buy side right there. And that's what you see. Then you have relative equal highs, which they'll leave in place so that way people will trust what? They'll think it's resistance. So if anybody sees that as resistance, retail is going to want to do with that. They're going to want to go short. They drop it down. Where does it drop to? What's this level? That's equilibrium. So the market comes all the way back down into equilibrium, rallies, and then we blow out the highs. I apologize. I wanted to get that portion out of the way before we got to the 8:30 news release. But now, excuse me, I'm going to go back up to an hourly chart for a moment. Yeah, air conditioner roaring, man. That's what a 5-ton unit sounds like in it upstairs. Okay. All right, so we have relative equal highs in here. So as long as we don't give up all this and crash back down, this right here is a draw. And then we have this wick. What did I tell you about the wicks? They're gaps. So while that high might be where it may go, it may not, especially on a day like or a week like we have today. So you want to measure. These are always in the wrong place. It's amazing how it's always like that. There you guys, getting quiet again. So 106.152. So that's consequent encroachment. So we can put a level on that. It's close enough for government work. All right, so with all of that in mind, and everything that's in play here and what I outlined, you want to go to your British pound versus US dollar chart. You want to go to your euro dollar chart. You want to go to your Australian versus US dollar chart. You want to look at your dollar yen. Meanwhile, have you seen the yen? Got smashed, right? The relationships to what the dollar index was doing, as I outlined it on the 15-minute time frame. Those turning points you want to look at how those respective pairs I listed that are dollar based, like pound dollar, euro dollar, how did they behave? What type of scenario did you see in those charts? I mentioned in the description of this workshop over the weekend when I was announcing basically my interest in wanting to do it. If we can see a number of continuation entry points, which is predominantly what you're used to seeing with me, very rarely do I ever touch on reversal patterns, because what does that really do? It flies in the face of me trying to teach new students, and there's always a new influx of new people coming to my channel. I don't want them to fall victim to trying to do reversal patterns, because that implies a great deal of understanding that may or may not be had by that individual that may be just coming to my channel, which is why I try to focus on learning how to determine where the draw on liquidity is. And if you can't determine where the draw on liquidity is, then you're the liquidity. You're going to get liquidated. So you don't want to trade ignorantly. You don't want to be ignorant to what the market's likely to be reaching for, because that's the most important thing. It's not where do I get in at? Where's my entry points? Because literally that's the least important thing, because you have multiple reasons to get into a move if you know where it's really going. The hard part is learning to trust the observations and the recognition in price to determine where it's going to go. Where is it reaching for? Because it's going to continuously grind or move in a quick pace to that level. If you're accurate, it's going to go to that level nonetheless. So you have to be able to submit to allowing yourself to develop that skill set. And it won't happen right away. It won't happen like overnight. It won't be a week. It won't be 40 days. It's going to be literally a year minimum, because every year there's seasonal tendencies that come in. And those seasonal tendencies, I trust, with over 3 decades of experience looking at these markets, obsessing over them, I trust seasonal tendencies. I trust these tendencies to repeat certain months of the year. There are times when it does way better than I expect, and there's some times where it doesn't pan out. And when it doesn't pan out, that tells me that I have something that is even stronger going the other direction. So if I get stopped out and I take a loss, trusting a seasonal tendency, trusting a market structure, market maker buy model or sell model, and it reverses on me, and I didn't get out of that or mitigate the underlying risk or close the trade before I got stopped out, and I incurred a loss, but that move flies against the seasonal tendency that I'm trading, I will flip the script and go exceedingly bullish or bearish, whatever the opposite would be, and trade it the other way. Because if a seasonal tendency is not underway or panning out, that's the market basically tipping its hand to you, saying, okay, listen, I'm about to railroad everybody going the other direction. So the first opportunity that I can reverse, I'm going to do that. And early on, back when I was on Baby Pips and I was doing recordings of my trades and whatnot, there were several instances of me doing that. And it was like, wow, how did you know to turn on diamond? Well, that's what I just explained. But those things are going to be experience driven. And there's no shortcuts. I promise you, folks, as much as these guys out there want to get the attention and have ad revenue and people loving them and worshiping them, they're never going to be able to condense this down to something simple and short. And I had people yesterday that I muted in my comment section. You can't see the comments, I can. But they're like, this is a really long video. I wish you would get right to the point. The point is you're never going to be a trader. That's the point. You can't learn. You don't want to listen to what works. How do you make this stuff work in your own hands? You have to have the author explain how you're going to be met with certain things that may be problematic, but this is how you overcome it. Some things are going to only be understood or overcome because you keep exposing yourself to the experience, and then you glean the experience of having done it enough times. Oh, now I know this. This looks like the model I always like to trade. This doesn't have all the signatures I like, so therefore I'm not going to take this one. I'll let it pass. That's the things I was talking yesterday. I was teaching that. But these TikTok mentality, individuals, I don't have time for them. I don't care about those types of students, because they're not students. They're dabblers. They want somebody to come in here and teach them a magic trick so they can go out there and impress everybody and get rich overnight doing it. It doesn't work like that. Trading's not like that at all. So if you look at how this relates to pound. All right, make sure I'm on the same time frame. Yes. All right, so I hope I had this up on the chart when I first started the live stream. I hope I don't know if I did. Well, I mean, it obviously was on the chart when I started streaming, but I hope this was on the screen before it acted as the inversion for your gap as I have here. But otherwise, it's going to really seem like lipstick in hindsight. But I want to teach you reversal patterns, and also look in the mentorship content. As a reminder, there's a bunch of roaches out there that are trying to sell my mentorship videos, and fools are buying them when it's all here for free. I don't know why they're doing that, but hey, you know, it is what it is. You want to throw your money at thieves when you can just come right here, warm up the ICT, pitch a tent, and learn how to do this for free. I promise I won't ask for your credit card number. The patterns, reversal patterns, for instance, like the false bull flag and the false bear flag. Okay, they're one of my favorites because when I first started, I bought this book called Technical Analysis of the Financial Markets by John Murphy. I'm telling you all right now, if you want to learn how to trade in a 90% club, you have to buy John Murphy's book, Technical Analysis of the Financial Markets. That book is the retail trader's Bible, and everything in that, if you fade it, in the instances where I tell you how the market's going to trade, you have a 90% likelihood of winning, and that stuff failing. So when I was designing all these things, I wanted to see how I was falling victim to bull flags, because when I first started trading, I only wanted to be a buyer because I didn't know how the market would pay me selling something I didn't own by being a short seller. Didn't make any sense to me. I was trading with no experience, putting money into a market after reading one rag of a book, thinking it was going to be easy, 1, 2, 3 tops and bottoms. And, I had my ass handed to me. So the first trade I put in, I lost half the money I put in the account. Well, not the account, but the trade. And that was it. I had to take a month or two off and regroup. It was shocking to me. I mean, it was a lot of money to lose $750 overnight in an option for orange juice I was shell shocked. But the time I was spent away from actual trading, I thought to myself, wait a minute, someone took $750 from me. So what did they do that I didn't know? And that was the beginning of my pursuit of trying to figure out what it is that the markets are doing when it does in fact move explosively, or in a manner that someone else had to obviously capitalize on that. And one of the patterns I like to trade back then when I was trading commodities, it was a bull flag. I was like, this is so easy. I can see these things. It's just so obvious in the chart. And it was so obvious that once I got in them, they failed. Because I had no understanding of where the market was going to go. So I'm going to teach you a secret on how to capitalize on fake or false bull flags. And the same thing would be said for a bear flag. You're just going to reverse everything I'm going to say here in terms of the logic, okay? But I teach this in the mentorship premium content that's in this YouTube channel. Look at the playlist. You'll see it. It's month 1 mentorship. It's month 2 mentorship, month 3, all the way through the 12 months. And then I gave you the 12 charter membership models. You have everything that you'll need to ever understand what I'm doing, okay? You don't need to buy the books that I'm producing. The things I'm teaching you this week are the gap fillers, so you don't even need the commentaries. So stop listening to these assholes that are out there on the street corners, okay, selling my stuff when you don't need to buy it. You're not going to, there is no study guide, by the way, either. Somebody's out there saying, can you give me the study guide? And the PDFs were just simply the screenshots of the slides that I transitioned through as I was giving the lessons. So if you want a PDF, you just simply screenshot every time there's a new slide or new information. That's all that was. So they're all lying to you, okay? I didn't teach a 90-minute cycle. I didn't teach you how my logo unlocks the secrets of the universe. All that's horse shit, okay? They're all just giving you some reason to buy something that I've already given to you for free right on this YouTube channel. So stop being a sucker. But I want you to look at how the market created this situation down here as we were outlining. So at the bottom of the daily fair value gap that we outlined yesterday beforehand, look at how the pound, which is this chart down here, you see how at that moment when we were trading down here at that candle at 12:30 p.m. yesterday, August 29th, that's this candle there. Okay, the market rallies up, and what's it creating here? If we were just looking at the chart like that, a 20-year-old inner circle trader, a Michael Joseph Huddleston, that thinks he knew everything because he watched or he read a book and he heard all these testimonies of how, yeah, I made $250,000 trading soybeans and I pyramided my position up to 250 contracts and boom, I made all this money. So yeah, I was thinking I could own the world with bull flags. I would have been buying that right there without the information I've provided to you. That right there, I would have been buying that. But that pseudo or fake bull flag in the pound is occurring at a time when the dollar index is at its deepest discount, at the low end of the fair value gap that I gave you the focus yesterday. Before it was there, before it traded there, that's 12:30. That's when I ended the stream, or maybe moments before that. The point is I started talking to you right away with the dollar index, and you knew about these levels. Okay. Segueing into how we use it for forex. When you see a pattern like this, when the dollar's doing something like that, what's going to have more emphasis or strength? Imagine Toby Maguire arm wrestling, a power lifter. put in anybody you know, or any small little specimen of a man, okay, or a child arm wrestling some weightlifter. It's no competition. The dollar's going to break the knees of any bullish retail pattern that you see in a forex pair. So what that means is you can fade this bull flag, which is going to be a retail idea that they think this is, it's an uptrend, it's continuing higher. Maybe they'll look at this move here and it's consolidated and that measure move calls for continuation on upside. Not when the dollar's telling you this, not when it's doing that. And then you get the false bull flag that breaks down. But now this is what I want to teach you as well. If this is going to be a false bull flag, the flagpole, retail-minded logic, let me maximize this because it's a little too small. This bull flag, it comes right back down in here. And this is where everybody does the 5-minute trainers of ICT content. That's a buy in their eyes. It's not. It's not. Because it's not going to go higher. Because the dollar's going to go higher. And that's going to hold the pound lower. So what you do is you looking for any inefficiencies. This fair value gap here, that will be a bearish fair value gap. You can see them working that level. But more importantly, the flagpole that would be used for a bullish bull flag in retail thinking, that's my inversion fair value gap. I'm looking for it to trade to that. Once it breaks, it's going to come right back up into that and then act as what? An inversion fair value gap. Where everybody else that watches 5-minute trainer guys on YouTube or Instagram that think they know my stuff, oh yeah, this is an inversion fair value gap. I'm sorry, this is a bullish buy side and bounce, sell side efficiency, or they'll call it a liquidity void. It's filled it in, now it's going to go higher. No, it ain't. No, it's not. Because I gave you the levels to focus on the dollar yesterday. I told you that the bodies tell you the narrative and the wicks do the damage. The body stayed inside the fair value gap on the dollar index. And it worked its buy model. I showed you at the beginning of this lecture today how each one of those components and PD arrays on the sell side of the curve as the market dropped down on the dollar index, how you use those as footholds and you wait for new PD arrays to form as handholds to climb up that surface of the sell side of the curve to get to the buy side. Well, the opposite is going to be seen in pound. You have a retail bull flag that will fail. When it drops down here, 5-minute trainer ICT gurus that are going to tell you to buy that because this has been rebalanced. It's not. The only thing it's doing is creating the inversion fair value gap that eventually trades up to it here and then aggressively moves lower. What is it going to attack? It's going to attack sell side. Where's sell side? Relative equal lows. When you have relative equal lows, you use the lowest of the low. That's where the liquidity is. If, this is for your notes now, if the lower low has a long wick or tail, use the consequent encroachment and it may not sweep below it. So you would take the majority of your trade off and that, like for instance, say this right here, see how it's done this? Say this low right here on that candle had this type of tail. What I would do is I would take like 80% of my trade would come off at just above the consequent encroachment, that wick. And then I would look to see if the runner that I had left on can get below that. You're going to find out many times that sometimes it just will not do it. But if you get out right at the consequent encroachment, you did it. You have the lion's portion of the move captured. But when it's blunt-ended candles like this and it's the lowest one, it's just simply use the low. And that would be this. There's your sell side run. So from here to here, that's your morning run based on failed retail logic, based on what I built as a premise yesterday in the dollar index, that daily fair value gap. Because it's a higher time frame level, what do? We keep those levels in focus because they're going to have a greater impact or influence over price action on the smaller time frames. So if you want to find the big runs, the big moves that start and originate and end at, they're going to be derived from the monthly, the weekly, the daily. That's where banks are trading off of. Okay, when I say banks, I'm saying that their large positions are being initiated, okay, or built on the levels that are derived from those time frames. High frequency trading algorithms that are not banks, but they're extremely large cannibalistic entities out there that cannibalize banks. They cannibalize large traders. They cannibalize other large trading entities. I'm teaching you how to think like them and how their high frequency trading algorithms engage and operate and cannibalize. The reason why people don't want to subscribe to what I'm saying is because it sounds conspiratorial. It sounds like it's contrived and made up. But if it was all made up, why is it so perfect? Why does it happen more times than all the other stuff? Why does it provide for the individuals that put the time into it, why does it create such a clear narrative and understanding of why the market's going to behave a certain way? Because it's uncomfortable. It feels like you're at a disadvantage. And the realization is wow, like I'm in here with apex predators, sharks, killer whales, things that can devour me. And I thought I was going to be able to come here and treat it like a video game. No, you're not, Virginia. What's going to happen is you're going to go in there and you're going to have your ass ripped off. You're going to lose an arm and a leg. Okay, your face is going to get torn off. You're going to be dismembered because that's what this business is about. It's about eating the weak, eating the small, surviving to eat another day. It's not about the 401k nest egg. I'm going to have a nice retirement. That's the selling point. That's the pitch that they give you. Just like the Instagram boys. Look at me. I'm getting ready to get a Lamborghini. I've done this and I've done that. All the stuff that they're doing is from sales of stuff. I've said it openly. I made more millions in selling education than I did from trading. I don't hide that. I've never hid that. But the things I'm teaching you, they work. They work in my hands. They work in my students' hands. And they have proven it over and over and over again. But you can't rush it. You can't rush it. You can't try to shortcut it. Believe me, if there was a way to have done it efficiently and effectively, I would have done that. I absolutely would have done that, because it made my whole time doing this a lot easier and frankly much more profitable. I wouldn't have had to spend 17 hours a day doing mentorship because I was the brain trust in it. I was the person making the videos and editing the videos and uploading them, and different watermarks being put on different user groups, and then having to deal with all the drama with students that thought it was going to be a signal service and didn't listen or read the user agreement. It's not a signal service. Like it was just a lot. That's another reason why I would never, ever, ever do another paid mentorship. It will never do it. I'll never do it. I don't need to, frankly, but I would never do it for the simple fact that it was a bunch of bullshit. Like, it was too much work for the amount of money. Yeah, it was great money, but I missed a lot of time with my kids. I missed a lot of time with my family, and my health went down. Like, I did not feel well, and I didn't barely sleep at all. But anyway, I digress. The point is, reversal patterns, for your notes, you want to be using a correlated market. In this case, if you're trading forex, you're going to be looking at an inverted correlation between the dollar and the forex pair that you're trading. So if you're going to have bullishness in the dollar index, your mindset should be switching to, okay, what do I have in the marketplace for pound that would instigate or promote a short entry? Where would the market trade to if it's going to go lower? Well, let's go back to that beginning of that bull flag right here. Retail sees that as it's going to go higher. Pseudo ICT guys see this as it's going to go higher because it filled in this and it's an order block right there, right? Wrong. Wrong. That is not a bullish order block. Why is that not a bullish order block? I just taught you moments ago. Think about it for a second. Why is this down close candle not an order block? What is it? It's a mitigation block. Allow me to explain. We have this low up to the high of the bull flag. I'm going to take this level off because it's a little too much information. Okay, so we have that range. So that's your dealing range. Why is that a dealing range? Why is that a dealing range? Am I going to reinvent a new definition for it? No. Sell side, taken, rallies. Above here, buy side. So we've done both directions. So you run your low to high. Equilibrium's right here. If the market's rallied, is that a bullish order block if we're above equilibrium? Hell no, it's not. Absolutely not. Now, can price come down to it there and have a little reaction? Absolutely. That's the bait. What you're going to want to see is that down close candle trade through it. Weaker-minded individuals that would use that as a catalyst or springboard for higher prices, they're in a net loss when it trades below it, right there. So now in their mind, they're thinking, I would really like an opportunity to get out of this losing trade and mitigate that loss. Oh, well, now if you take that, I know it's hard not to smile, ain't it? Man, this is so good and it's fucking free. You're damn right. So here's that down close candle. Look at the high and look how that performance is right there. It overshoots that fair value gap. Where's it go? If it's going to color outside the lines of that, where's it going to go? The mitigation block right there. Sorry, folks. Nobody else teaches that. Just me. Good old ICT. So when the market does these types of things, you have several factors here. Remember I was telling you? A PD array, in and of itself, one thing is useless. You have to have three things to confirm it. So what do you have here? Mitigation block, inversion fair value gap, the dollar index creating a reversal scenario. So if the dollar's going to go higher, sorry, the air conditioner's kicking back in. The dollar's going to go higher. That's going to put a lot of resistance on any advance or moving higher on foreign currency. that has the dollar index second in its name. British pound versus dollar. So if dollar is going higher, the front named currency in pairs that are coupled with the dollar being the second in its title or name, they're likely to bend the knee and go lower or fail to rally. And then you have situations like this where the market just really just falls out of bed. Now, once you adopt this holistic approach to not just looking at one side of the marketplace like I was as a 20-year-old, I only wanted to focus on being a long holder. I wanted to be a bull. I was a perma bull, and it made sense to be a buyer. It didn't make sense for me to try to sell something I didn't have and be a short seller. So because I was uncomfortable with that and I was afraid of it, and I was afraid that I would lose money faster because I would always notice, and I was observant enough to notice that when markets drop, they drop faster than they rally. There's a whole lot more speed when the market drops. And back in the 90s when I was trading first, there was a lot of movement that was taking place, and we had some really nice commodity runs that were just phenomenal. And it just scared me as a new trader because I didn't have a whole lot of money. I borrowed $2,600 on a Nations Bank. Nations Bank doesn't even exist anymore, but a Nations Bank credit card. I literally took $2,600 off of a credit card and put it into a brokerage firm called Fox Investments back then, and literally took a trade in something I never understood, which was options at the time. Never even learned how to do anything with them. I was like, well, orange juice should be doing something amazing here, so I'm gonna buy this option. And the only thing I could risk is the $1,500 I paid for it. Well, in hindsight, I was buying an option that was overvalued, had very little time life in it. Its intrinsic value was going to fall off precipitously. And then I had a directional move that went against me overnight. So everything that could have went wrong in that first trade, I was baptized and had my ass literally on fire. And I couldn't get the broker to answer the phone fast enough to tell him to give me the rest of my money, to send it back to me. And I was a mess. Like I couldn't believe that happened. But that's what happens to everyone. Everyone enters it too fast. They think they know how to do it. They think they understand it, and they put real money to work. And that money works against them, and it usually leaves them. A fool and his money is soon parted. And that was true with me. And if it's happened to you, you're in good company, because everyone that eventually figures this out, they all have that same story. It's somewhere in their career they did something like that. And if they've been trading long enough, they've done it more than once. And hopefully they've learned how to avoid those types of things. And I try to spend my time coaching you, reminding you that you're trying to avoid something that's going to be inevitable. You're going to make a mistake. You're going to have a losing trade. You're going to see something in the chart that you think wholeheartedly is there, but it's really not. And when you do lose, and it should be a loss that you can sleep with, that means you're comfortable with having it. I lost, I did it wrong, so therefore I can come back, and it doesn't change my approach to using this information. It doesn't make me sour on this where I need to go jump and start learning something new, because you're starting all over again if you leave whatever the school of thought is that you're employing as a trader. When you system hop, you're literally going back to square one, and you have all new anxiety, performance anxiety, high expectations. This better do better than the last thing. That's unrealistic. So you're already priming yourself to fail, instead of just saying, you know what, I see this stuff working. It makes sense. I don't understand it fully, but I see other people making money with it. They're proving that they make money with it, not just tape read, not just demo trade. They're literally making money, spendable money. They're quitting their jobs. They're doing this full time. They're buying things that would otherwise be outside the reach of the average working class individual. They're paying cash for their homes. They're paying too much money for cars, and I'm guilty of that too. I'm a car buff, but if that's your thing, that's your vice. You worked for the money. You spend it how you want to spend it. But there's enough individuals all around the world now that will co-sign and say that this stuff is absolutely what I've said it was. And you have a chance to literally spend time testing it, listening to how it is as the author, and that's who's talking to you. If you do it the way I'm suggesting, it's going to take you some time, yes. But if you went to college, you're going to go there for 4 years, not necessarily knowing that when you graduate, you will enjoy doing that career. But I'm going to tell you something. Do you think you're going to have any difficulty making $50,000 a month? Like how often are you going to get pissed off and hate life because you made $50,000 in 1 month? How many times are you going to look and say, you know what? I made $2,500 in 25 minutes. This is bullshit. Something needs to change around here. That's not going to happen. That's not going to happen. But I understand in the beginning, you want over the top, like $1 million in the first 6 months, 3 years, or whatever. Well, not 3 years, 3 months, 6 months, in that short little span of time. And you've elevated the expectation and placed so much difficulty on why you're even doing it. These little failures that are all normal, these little resistance points of growing pain, of learning how to do this, they're going to be perfect excuses for you to say, you know what? I really don't have it in me to stick to this. I don't have it in me to be responsible and accountable to myself. So therefore, I'm going to use the easiest exit ramp that comes to my, present circumstance. And I'm going to use that as say, I just, it doesn't work. It won't work in a fool's hands. It won't work in a lazy person's hands. It won't work in a 5-minute trainer student for somebody else. Okay? Believe me, talking less doesn't make you understand it more. Doing it, having an understanding of it, and using it precisely, that is understanding. And unless they can do that, they can't teach you, because you can't just talk about it in hindsight. You have to outline it. Like I gave you that dollar index fair value. You got to watch that. I told you you could drop down in there. But where am I really pointing to for the week? For Monday, Tuesday, and Wednesday, I think that they're going to want to draw up into those levels. So it doesn't mean that I'm only going to take a trade in that direction. Like as I mentioned, this is a week where we don't try to trade daily bias. We trade without a bias. So when you have a trade like this, where it runs the low on relative equal lows, once it does that, you're done. You're not in here trying to trade more. You go in like a cookie cutter shark, you run up on your enemy, bam, slam into them, get a bite, and run away. That's it. It's guerrilla warfare. That's what it is. Surgical strikes, get in, get your money, and go. Don't hang around. Don't go back in again. Don't do another trade. Don't look at, I could have made more if I would have held on to it. Who cares about all that stuff? You turn the charts off, go do something else. Conditions and market environments where you do not trade with the daily bias, you are trading intraday volatility. You're not in here trying to capture every fluctuation. You're not in here trying to get a centerfold of execution so you can go on social media and show that, look at all these moves I did. I'm more impressed with the individuals that go in and because we are in a really very difficult market environment. And anybody that tells you otherwise is full of shit. Okay? Because there's so many things that could pop off and change everything instantaneously. And because it didn't happen to the person that's bragging right now, it will happen eventually. And they'll go quiet. They won't talk about anything. They won't do anything because they're getting their asses handed to them. And then they'll come back when they have something good to talk about. So, surgical strikes, guerrilla warfare type trading when it's intraday without a bias. And that's what this is here. You're not trying to get the highest high. You're using the expected turn based on a stronger dollar at the low of that daily fair value gap that you received yesterday. And then you use everything in concert. And if you can apply retail logic as a catalyst to be the opposing view of what it is I teach, You are doing the very thing that John Murphy's book says you should be trying to do as a trader. And if the statistics are true, and I believe they are, 90+% of retail traders do what? Make a lot of money? Fuck no. They lose. So when you look at John Murphy's book, that's the Bible. That's the gospel for the 90% losing crowd. So there are times when that stuff will work, but it's so infrequent. So if it's more apt to be what? Incorrect, unprofitable, and you can couple it with something that is really the marketplace and how the market's book price, you have the highest form of advantage there is. Now think about that in contrast to using a harmonic pattern. You're just looking at Fibonacci ratios and thinking, well, this should go up because bats fly, so that means it should go higher. This is a Gartley pattern. Everybody knows the Gartley pattern is harmonic, so the market should behave and respect that Fibonacci level. Bullshit. You're looking at things myopically, one-dimensional. The only way a person's going to have a high degree of precision and consistency in trading is they have to compare and contrast a weaker versus the stronger. And that's not an alien concept to you, because when you're trading forex, that's exactly what the fuck you're doing. When you look at this pair here, the pound versus the US dollar, if that dollar is at the low of the fair value gap on its daily chart, it's likely to go higher. More so when you see the body stay inside the low of the fair value gap. And then you start seeing it move towards all of its discount arrays that should send price higher. You have all of that in concert with potentially seeing weaker prices in cable's pound dollar. That's its nickname. So if the dollar's going to go higher, that means it's the stronger. And you compare it with what? A weaker currency. Well, that's this pound dollar. Since the name of this currency starts with pound, if dollar's going to go up, the first currency in this pair's name is going to drop. And that's what you see here. Now, if this was an environment that was not what we have for the week, and I need to wrap this up so we can go over to stock indices. We're going to take a 5-minute break at 5:15 to 5. I'm sorry, at 9:15 to 9:20. We'll have a short little break because I got to get something to drink. But when we have a environment where we are trading with the daily bias, you would take this entry up in here, go short, and then add to it here with that fair value gap. It breaks down when it trades up into the inversion fair value gap and mitigation block. You add to your final portion there, and then you don't do any more adding. You just ride it out, and you would hold for the day. That is not what we're doing today or this week, because of the economic calendar being what it is. It's a landmine field. So your range, okay, as we'll see when we look at the Nasdaq, it can create higher highs and lower lows and keep smashing both sides. So that's not what I was suggesting was going to be the specifics of what we should be doing this week. In other words, we were not looking to trade daily bias. We were trying to trade without a bias because of the economic calendar. Now, when the economic calendar isn't frothed with all these high impact news drivers, I mean, we got non-farm payroll. Usually what that means is I teach my students to have all your trading done by 11 o'clock in the morning Wednesday. So the close of the AM session on Wednesday, standard protocol for non-farm payroll weeks. And what do I mean by that? When you look at the economic calendar, typically not all the time, but first Friday of every month, the employment data, the non-farm payroll news release that's given on the 8:30 hour Eastern time. That day and the day before, that Thursday, those are the lowest probability trading days of the month for me. Now, that doesn't mean I can't go in and make money or trade them. I've done that. You've seen that. But I'm more apt to be incorrect. I'm more likely to do it wrong. I might see something, and if I have real risk behind it, it may fail. And then I will feel bad, more so if I would have just traded any other day, because I don't want to trade those days. I know my probabilities are shifted against me. But after 8:30 on non-farm payroll, 15 to 30 minutes after that, I can trade the rest of the day with no problem at all. But prior to, because no one knows what they're going to do with that non-farm payroll number. Okay, no one, because they're really manipulating the marketplace on that report because it's a very important, crucial piece of data, and they can control a whole month or a quarter worth of trading market sentiment with that one report. And then they hold on to that number, expecting the next month's data to be improvement or expecting it to be weaker. And then that creates another shock to the system and the market sentiment that's existing, or engineers a new sentiment. So that's the reason why I stay away from that Thursday and ahead of non-farm payroll Friday. And I've gotten real used to just not worrying about those 2 days. But every other day is just another walk in the park. I'm not concerned about anything because I know what I'm looking for. I know what I want to avoid. I've walked the path enough to know where the thorn bushes are, where the snake holes are, all that stuff. So anyway, let's take a break. I'm going to go and put our chart on Nasdaq. And we'll come back after 5 minutes and we'll continue our carnival-like atmosphere. All right, folks, welcome back. Hopefully you got yourself relieved there for a moment. We probably won't have another break, so suck it up, Buttercup. So we're looking at the Nasdaq. This is a 15-minute time frame. So before we get our open at 9:30, I'm going to go through the high time frames. We don't need this now. The daily. Okay. So as a reminder as to what I'm interested in, I want to see either today or by tomorrow, Nasdaq get up into its sell side imbalance, buy side inefficiency. If you recall, I wanted to see it trade up to the low, the lower quadrant, and consequent encroachment. And I'll add those levels again, so you can see that they are 18,054 and a quarter, 18,021 even, and the low is 17,988 even. Okay, so what I'm saying is I want to see a move that reaches up into there. Okay, now what happens if it doesn't do that? That's fine. I didn't lose money. That is the number one rule. If you don't get a move that is set up to go where you think it's going to go, and it just goes the other direction, you didn't lose any money. If you waste time and mental capital, oh, I wish I would have did it the other way, you're losing mental capital. You're losing mental capital, which is much more valuable than the actual money or equity that you have in your account, because that can be replaced easily. You can get a second job, sell something, whatever. I've done that a lot when I was a 20-year-old. The mental capital, that's real hard to get that back, because when you're mentally bankrupt as a trader, you could have a winning system, you could have, a track record of making money, but when you have spent your mental capital because you've either blown out an account or accounts, and now the flavor is failing a funded account challenge or having a funded account and then losing it because you go into a tailspin, go on tilt, and do everything wrong, you are mentally bankrupt as a trader at that point. It doesn't mean that your system wouldn't work if you try to trade it again. It's just you can't muster up the confidence to press the button to execute on it. So it's real important that you're constantly balancing that stuff out as a trader. Those things are real. They're tangible barriers to you succeeding. And I didn't know about it until I endured it. And not enough, even Mark Douglas doesn't really scratch the surface deep enough, in my opinion. Nobody, in my opinion, has really made a good enough trade psychology book. And that's why I like listening to other traders that have been trading as long, if not longer than me, because I love how they describe how they deal with adversities. I don't care less, how they trade. I'm not interested in learning how to trade from somebody else. I'm interested in how they weathered that stuff. So my emphasis is picking a place where I think the market's going to draw to. I'm completely comfortable with it being wrong, because if I'm wrong, I probably will have something that tells me it's going the other direction, because I have a lot of entry methods and techniques to get into a move. But I need to be convinced that my draw is inaccurate. And if it's not accurate, then I have to recalibrate and say, okay, well, if it's not going where I think it's going to go, then I need to reassess and see where it's going in the opposite direction. If I can't discern what that is in a very comfortable manner, where then it becomes one-sided in that regard, then I have a low probability condition and I do nothing. I sit still. I do not flip and go the other direction. That's a very hard thing to articulate or teach someone, because it's all experience driven, which takes us back to why I teach people to focus on learning how to do one side of the marketplace only, stay on that side. And if you don't get a setup that fits that criteria in that draw, don't trade, not even in a demo, because you're going to build bad habits. And bad habits are really, really hard to break in general for humans. You know, if you're a smoker, how many times you try to smoke, quit smoking? You're overweight. How many times have you tried to lose weight? How many times have you tried to gain muscle, young men? And then he's like, well, you know, my girlfriend said I don't really need to look like that, so it's easy not to want to do it. Or, oh, my legs are hurting. Now I'm going to skip leg day. Pussy. But anyway, the low, I'd like to see it trade up there. We are building a down close candle here. So it could happen today or it could happen tomorrow. It could happen at the FOMC rate announcement and they send it up in there. Or, you know, if I'm wrong, it completely breaks down and trades lower and goes back down into these 2 wicks here. See that? Whenever you have a range, this is something for your notes. Whenever you have a range that's encapsulated by 2 opposing wicks, we have this tail here and we have this wick here. What you want to do is you want to get a measurement of both of those candles and where their consequent encroachment is. See that? They're essentially the same thing. Sometimes they won't be so close in proximity. What you do then is you create both of the CEs, the consequent encroachments. They will act as a fair value gap and they'll trade right down into that. This is not something that occurs a lot, but when it does, if the consequent encroachment of both of those wicks, or in this case, it's a wick and a tail, whenever you have that, treat that as a fair value gap. Many times, if your directional bias is correct and it trades down into it when you're bullish, that will be your turning point. It will completely go above everybody else's heads. I've done this in execution videos before. Okay. If you go through all my execution videos, you're going to see sometimes where like I'm doing something that I've never taught. One of them is this. Okay. Why does it happen? Because wicks are gaps. If you go to the midpoint of the gap, which is what it can do, what? It's consequential that it's encroaching on the mid part of that range. Hence, consequent encroachment. So if you have 2 different but in close proximity consequent encroachments, that creates what? A gap or a fair value where price could tap into it again because both consequent encroachments levels could be traded to. But we also learned that consequent encroachment may not be traded to. In the best instances, they aren't. It's always the upper portion may not be tapped in the middle, but the upper portion when you're bullish, lower portion when you're bearish. So all these things, these rule-based ideas, they're just too good for the public. That's why I kept it to myself for such a long time. But things are about to get really hard, and you know, I'm loosening my grip on all this stuff because, you know, I just feel good about doing it. But that's one other PDA rate that now you have learned. So the low of the fair value gap in this lower quadrant up to here, and I remember I said yesterday, if we can get a closing basis above that, then I would look for it to trade to the full closure of this sell side imbalance, buy side inefficiency. And if it can trade above that, if it comes back down into it, this would become a inversion fair value gap. But that's all contingent upon if then, if then, if then, if then. Whereas right now, I'm just waiting to see if it can set up a scenario to drive up to that point. Because that's all I need for this particular week. I'm just looking for a setup that's so overwhelmingly obvious that it's so obvious and it's like a gift. That's the only move I'm trying to capitalize because of the economic calendar. I know if I went in here this week and tried to trade, you know, up, down, all over the place, do multiple trades, I would have more losing trades than I'm comfortable with having. So that tells me to dial back my frequency of trade, tells me to sit still. Okay, so let's go down to a 1 minute chart. All right, so we have all this SIBI in here. Let's take a look at it from the regular trading hours. You can see our opening range gap. That's here. We're going to highlight that now. Opening price to closing price. So we have a discount opening gap. It's likely to come back up, but we don't need it to go all the way back up. The midpoint is usually, like, that's the strongest likelihood of a return back to a opening range gap. So how do you use that? Let's go back into electronic trading hours. I didn't do a good enough job articulate that mid-range level. Let's do this. 50%. And we'll make it solid. No, let's not do that. Red. Okay. And then back down into electronic trading hours. So there you go. There's the midpoint of the opening range gap. So in a morning like this, see how we have just basically the drifting, grinding back up in there. Now we have an opening range gap that has gapped lower than where we settled the previous session. We have all this SIBI. Midpoint of the gap is here. We have relative equal highs here. We're opening in a discount. We had high impact news at 8:30. It's dropped. So retail is going to want to continuously sell short. They're going to be looking for shorts. They're going to be looking to get below here. It can, and this is why you sit still, it can drop down, take out these relative equal lows, and then come right back up to mid gap or higher if it wants to. But in this instance, this is where I sit still. I don't do anything. I observe. I watch. If we didn't have the economic calendar like we have this week, I would be looking for opportunities to maybe get a run just below something like this and not take the lows out, thinking that that would trap traders short, and then reverse and then look for a ride back up into the consequent encroachment of the opening range gap. But in plain terms, we do nothing. We expect nothing. We're observing. We're submitting ourselves to the first 30 minutes. That's the opening range. That is the opening range, and that's the time frame you want to be focused on. Nothing shorter. It's the first 30 minutes. Why the first 30 minutes, ICT? Because all of the buy and sell programs that large institutional traders employ, they're funneling their orders in for the first 30 minutes. They're using all of that liquidity, that rush to buy and sell that they know is there, it's prevalent. They're literally forcing it in those first 30 minutes. So if you're hearing somebody say the 15-minute opening range, that's horseshit. It's 30 minutes. And then at 10 o'clock, you start your silver bullet. Now what I'm going to do is I'm going to overlay ES. And I'm going to compare that's not what I want to do. Okay, so far slightly higher highs, higher highs. All right, see that candle right there? Nice green expansion right there. That could create a fair value gap because this candle's performance as it is right here. If it doesn't run right to the midpoint of the gap, we're watching right in here. Usually when it's this far in the animated, it doesn't usually come back down and give immediate rebounds. Usually it's opening, staying inside the candle that created that expansion, and then it drops down to create an immediate rebalance. That's usually the signature I like to see for immediate rebalance. Now we have fair value gap there. You're watching price. See, does it behave in a manner where it supports this counter raise, or do they break? You're trying to observe that because this gives you the intel going into the 10 o'clock hour for silver bullet. Aggressive traders, they could be taking trades on this stuff, but I'm suggesting that I wouldn't be doing it because of the economic calendar, the climate, the day, Everything about this is just sit still, don't rush. I don't remember turning the microphone on. Let me double check this real quick. Hello, hello. Yep. All right. That would have been embarrassing. The sit and wait. It's the hurry up and wait about trading that sucks. So now we have our opening range. We have the midpoint of the gap, which is always a high probability potential draw, because if it's going to go higher, it's going to meet that level initially. If it's going to go lower, many times it'll go up there, then go lower. But if it fails to go up there and starts to break down, what does that tell you? It's telling you that it's very, very weak. And if it's very, very weak, that means we're probably going to see a large range day to the downside. So all those factors that I just said, they should be in your notes. And that's the stuff you're trying to decipher and determine while waiting in the first 30 minutes. Because you're going to give up really ideal entries on certain days that you don't know for certain are going to behave or perform a certain way. So you have to just let that go. There's always going to be a better entry that you could have taken. And if you spend time, mourning over that, it's wasteful use of your time and energy. And it builds bad habits. It builds toxicity. So I'm going to minimize this. We're going to come back to that in a second. I'm going to peek at the dollar index. Notice the reaction in the lower quadrant on that opening range gap. That's this level here. So we traded back up into the opening range, and then we have displacement to the downside. So what we'll watch for is, do they want to use this as inversion? If it can come up and hit that and roll back over, your attention should go here, and higher dollar should be as a result. When you don't know what you're doing, this is the time where it feels like it's going to go here, it's going to go there, and you feel like you want to chase it doing whatever direction it's moving. And the people that have experience are more inclined to sit still and be comfortable sitting still. Okay, watch the midpoint of this. We're not getting anything out of the dollar yet. Reaching for that mid-gap level on Nasdaq with no participation on the dollar at all. I'm going to take this shaded area off. We don't need to have that there, and we know what the opening range is. This is that midpoint of that opening range gap. What I'm looking at and considering is, do we hit the midpoint of the opening range gap and not take out the low on dollar? Then want to see if the dollar wants to rally. If we fail here on the dollar, that means we've cleared the buy side here. They left this intact, and then the sell side would be potentially a consideration for intraday today. Here comes your mid gap. I would have preferred it come down to that mid level. That's why I was saying watch that, because if it would have touched that, then I would have expected this to expand up. So it didn't get to the level I would have liked to have seen. So if this would have been a trading day, I would have missed this run. And it's probably a good thing, you know. If it wants that mid gap, it should do it now. There you go. So now on the 1 minute chart down here in the lower left on Nasdaq, we have buy side here. I'll take these levels off. So there's buy side there. And a little bit more liquidity, I think, would be resting above those. And the reason why I say that is because it's the higher portion of this consolidation. So the liquidity resting up there would be in more of an important buy side for me. There. I'll just make it a little bit different contrast. Either one of these here, they're potential candidates. If they sweep it above either one of them, if we really start to break down, they might want to come back up, or come back down rather, to clean up this. This is a little too smooth for my liking. We're inside of a 30-minute fair value gap. Nothing here today I would have traded on yet. I'd still be sitting and waiting to see what we're getting built up for the 10 o'clock. Notice how we took that midpoint out on the opening range gap on Nasdaq, but we did not take out that low on dollar. I was saying, use the DVR settings. You can rewind back to when I was saying it. If not, just put this time on your notes so you can come back and listen to where I mentioned it. I'm watching it to see if we get up to that midpoint gap, or the opening range gap rather, on Nasdaq, and if we take out that low on dollar. We didn't. So that to me implies that this is a suspect rally. We just went to mid gap, and we might just come back down and take out the sell side here and then see dollar rally. Right where it's at right now, it can go either direction. So that's the definition of low probability. Dollar's a little too limp in here. About 9 minutes, opening range will be done. Then we enter silver bullet 10 to 11. both the buy side at 896 on Nasdaq and the sell side at 824. Both are just really ripe for the picking. I mean, they can literally, here's that midpoint of that gap I was telling you earlier. So looking at this high down to that low, if we continuously rally, there's no inefficiencies until we get to here. And that's inside of this as well. So is it more likely to get to that level as a premium, or come all the way back down and disrupt everybody from the beginning of the day at 9:30, where they went straight long? They left this area here. To me, it seems like they're trying to sell the idea that that's support, and that's going to be the largest pool, initial liquidity. So in my opinion, I'd like to see that swept and then run for 896, 910 Nasdaq. But I have nothing to key off on it yet. How we traded to it, the mid gap, hitting it there, just like it did on that candle, I would have preferred it had done that on this one. Then that would have been much more trustworthy to see it run for 896, maybe expand to 910. Doing it this way in such a close proximity to the, like these are the initial lows of the day. So at 9:30 we opened here, and then didn't go lower there, didn't go lower there. So this is like, I feel strongly that this is going to get engaged, but I don't have an entry to get into it yet. And I'd prefer it get swept first and then open the doors for 896 to get ran. But if we run 896, any short-term break in structure lower, that would be the catalyst for a run down to slide between 824 and 820 Nasdaq. See how it's like it's not in a hurry to go anywhere right now. And that's an environment I don't like to trade in. That means they're reserving a great deal of pain later in the session. Somebody's going to get their hinder parts handed to them. If it wants to go higher, it needs to do it here. See that dollar, upper left-hand corner? Did not take out that low. I don't have the folks that I usually look at. And I don't know what their chat rooms are saying, so I don't have a sentiment reading right now. And the reason why I'm not doing because I'm not very proficient with using live stream stuff, so I would be concerned or nervous that I would flash their live stream and embarrass them, and I'm trying not to do those types of things. So we're just going to read price. If you look at the gap that I'm highlighting here, there's a small one right there. So we traded up to both of them, midpoint, and then that small little one there. So if dollar continues to go higher, I would expect to see a displacement lower on Nasdaq, and that would set the stage for a run below 824. I'm not trading it. I'm not pushing any buttons. I'm literally just explaining what I'm looking at live. There's no setup as far as I'm concerned yet. Trading above it, acting as support, would set it for 896, 910, 3/4. Who's made money so far since the opening bell? Longs or shorts? Long holders are in the money right now. They left those smooth relative equal lows at 824. Sweep of 888 is likely, and how we trade there is crucial to what we do for the 10 o'clock silver bullet. Five-minute chart on Nasdaq in the lower left-hand corner is trash. But there's really nothing to get too excited about. 1 minute isn't all that more inspiring. Come on, 896. That's classic on a week like this. They get right to the level and then pull it back on you. That's why you gotta be real careful. So we swept the 888 level. Longs are long in the tooth right now. That means they're feeling good, but this is what they don't want to see. They don't want to see any kind of sharp turns lower. Frankly, I do. I want to see that the fact that we didn't go above that high, that, you know, to me is interesting. But this looks way too ripe down here. Let's get a look on the even the S&P. divergence. See? High, high. Is that higher on the second one? No. Now, if we can get up to this range again here and kiss that low of that shaded area with dollar rallying, that would be brilliant. Immediate rebalance. Am I right? Let me see what's the low on that. 68 3/4. High. Yep. Immediate rebalance. Dollar's just sleeping in here right now. Look at S&P. Yeah, it looks like trash. At the peak at euro. My side. Cable. I definitely would not be in S&P. That's for sure. S&P doesn't have anything that I'm interested in. Dollar giving way. That daily fair value gap's high in the upper quadrant of that imbalance. So this level here to about there. That would need to be support for dollar. Otherwise, if it breaks below that, we're probably going to see it give up the ghost and run for its sell sign. Nasdaq has cleared relative equal lows, rejected that. Now we're inside of this. This could potentially be reclaimed fair value gap. That's not inversion, even though the color's orange. Reclaimed order block, reclaimed fair value gap is when the initial expectation is used at a later time. Inversion fair value gap or mitigation block is when they reverse their role. I would prefer that touch the midpoint again. 896 is in play. They have more stops sitting right above that. So far, I don't feel I've missed anything. I'm not antsy. I'm not anxious. I feel like there's nothing here so far. Okay, there's that touch to that midpoint of the gap on Nasdaq. Now, can it find legs to reach for that 896? given the economic calendar and where we're at technically in the market for Nasdaq, the levels I have on my chart, they're the ones that are salient to me. That's what I'm interested in at the moment. One or the other being traded to. Like if it goes here, I want to see if it can expand here. If it goes here and goes above it and breaks down, then I'm looking for a run there. If it were to drop down below these lows here, then I would look for it to run back at a later time to take out the 896. So we're not in anything that I would be interested in. All of this is still just waiting. And I know it's it's frustrating because I want to be able to know what it's going to do right now and do something. And every little fluctuation feels like it's the beginning of something big. And you can't think that way right now. There's so many, like tomorrow we have the Fed. So all the big moves are reserved for tomorrow and non-farm payroll. So you have to kind of like remind yourself to just anticipate the moves to be stunted, held back a little bit, only going to take out stops and then back to the middle of the range, take out stops and then back to the middle of the range. So that's the like the playbook in my mind. It's what I'm watching for price. And since we're between the parameters that would constitute an interest in me making a decision going higher or lower, neither of the levels I've outlined here have been engaged yet. And because we're in the middle of the range, we're in no man's land because it can literally go either direction right now. And if it can do that, that's a gamble. I'm not trying to gamble. You're welcome to do what you want to do, but I'm not out here trying to just guess. Sitting here just shuffling cards and waiting. Looks heavy on Nasdaq. So let's take a look at something here. Get myself comfortable. We've had the initial high here taken out at 944 with that run. We broke low, relative equal lows, rallied up, failed to take out the high, didn't even get to consequent encroachment of that wick. Fair value gap from here, it's displacing. Your eye should be right there. We're on a 30-second chart. Let's see, let's drop down to a 15-second. Show you something. This. Dollar index is just taking a nap. S&P, if you look at it down here, it's down taking its sell side. It's got real smooth edges. So we want to see if this can be traded above, if it treats it as support. That might be the catalyst for drawing the S&P higher up, clear up its relative equal highs. And that right there. Remember, we have this portion of the gap, the opening range gap, that's unfilled. So between this high here and there, that's the range you can trade up into. So that would look like this. That's the remaining portion that's unfilled. I apologize if you can't hear me loudly because the vent I'm underneath is literally like a freezer. It's blasting me. I'm not complaining, but if it's distracting to you, I apologize for that. So there's been fluctuations, but none of this is of any interest to me. I'm watching the bodies in here to see if it's staying inside this gap. Because this buy side that I liked and annotated earlier, that or the sell side down here, one of the two, I could care less really which one. I would have preferred that it would have came down initially and took those relative equal lows out. Then I would be just bullish. Right now I would have been bullish remaining. But neither of the levels or the liquidity that I want to see tagged has been tapped yet. So we're in between those two things. So in my opinion, while it could be viewed either direction, I see that we're in an area or a range where it's like a boat without a rudder, and it's just going to just drift and coast wherever the tide takes it. And if you trade in those environments, you're literally just gambling. The S&P, because it has its really smooth highs like this, and we're real close to it, I think we're going to see that get breached. So we would have to anticipate some kind of sympathy move for 896 to be considered. this shaded area up here, I'm going to change it to a different color. That is the opening range, remaining portion of the gap that has not been closed. Sorry. That's one of those things that would have been edited out when I pre-recorded. Don't yawn, ICT, they're contagious. All right, so dollar index has tapped its daily fair value gap high. How you are able or unable to manage your patience or lack thereof in between setups is going to be instrumental in terms of how fast you find success and how long you remain consistent in that success. Just because there's fluctuations on the chart doesn't mean there's a reason for you to be in there. Not with a proper high probability condition behind you. Now, I like to ask myself, rhetorical questions like, if I was long from the opening, would I feel confident right now? If I was short from the 89s, would I feel confident right now? Both instances, I wouldn't be overzealous about the position I would be holding in either side. So that also helps me frame the probabilities of a directional move higher or lower. And because I can't come to any conclusion yet based on that, I don't know if 896 or 824 is going to be hit first. And without having that insight, we're in the middle and it's a 50-50. It's literally a gamble. And I'm not trying to teach that. I don't trade that way. I don't look for moves like that. It has to have its hand tipped to me, and I feel confident that it's one-sided. That's not trend trading, by the way. It's just that the market's predisposed to go to one side of the market, the discount or premium. It would need to run higher here. If I was long, like if I was bullish from the opening, I would want to see it be using this fair value gap where it just tapped into. Like it would need to, well, it's started to here, but it can quickly just fizzle out. But I would want to see it really rip and take out this high here. And until it does that, I would be apprehensive and somewhat anxious about it still potentially coming back down for that sell side. And while you're learning and you're not demo trading yet, and you shouldn't be in a rush to demo anyway, because you have to know what you're doing and what you're looking for. Otherwise, you're building bad habits, and you're trying to learn how to impose your will in the marketplace, which never works out well. But the exercise I was explaining to you is from the opening bell, ask yourself, who's making money? Who's profitable right now? Who has a hold on the profit for the day? Right now, we still have a little bit of an edge on the long holders. So they have somewhat of a position that's modestly profitable. That can change, or they could deliver to 896, and if they're smart, they would peel off there. But I personally wouldn't be comfortable where we're at because we didn't get that run like I would want to see off that fair value gap there. We got a reaction off of it, yes, but we're just having a hard time with the bodies to get through this gap. You see how the bodies are respecting that gap still. To me, that's something that I would not like to see in a long holding position for a run that opened at 9:30. So look at the price action right here. Really, what did you miss? Nothing. It's a lot of up and down, give and take, and it's not really done much at all. But ICT, I did 12 handles right here. I'm killing it. Well done. You're a better gambler than I am. Man, S&P is poison. Look at that. I would not be touching that one. So how about all that drama at the colleges? Another reason why colleges are a scam. People paid money to go there, and that's what's going on. Unbelievable. It's going to be a wonderful summer. Hope you're ready for it, because it's going to have a whole lot of stuff. It's going to have like a potpourri. a whole bunch of mixed events going on. None of it good. All right, so we have really clean lows here. So there's a nice pool of liquidity there. And if we drop down, it could accelerate to reach for that 824. We have a volume imbalance in here we just traded to. So we want to see, does it have the ability to fall out of bed here? It's tried multiple times, reaching, all of them. All of this action on the upside in the premium level has been jagged. And everything on the sell side has been relatively smooth. That means we have these lows here. They're seeing that as support, and you know what rests below support for retail traders. That's where their stop loss is. And the same thing can be said over here. So we'll watch and see if we do in fact get this to roll over and attack that 642 and 824. That's probably random. So that's about a 20 handle run from volume imbalance to sweeping these lows here. And what you would want to see is heavy, drawn out, large candles now, because they don't want to see these individuals remove their stop losses below these lows. So that would indicate that you would want to see and anticipate rather, large ranges reaching down there. That would be the ideal scenario for the price to reach for it, not just drift down there. Sounds like my son's building something down here. Can you guys hear the birds? I'm asking that rhetorically because I don't know how you're going to respond. I guess you can leave it in the comments. But can you hear the birds chirping? we have birds literally laying nests over top of our windowsills, which is fine. I mean, I have no problem with that. Peaceful sounding. Watch the bottom of this. And then draw it down into here. Cue the Jaws theme. Yay! I've been waiting for an opportunity to use that. I found that over the weekend. I don't know if it's used for anything specific, but I thought it was kind of cute. My wife was like, why don't you use that all the time? Because I'm fucking ICT. I don't do that kind of shit. Are you crazy? But I felt like I had to do it so that way I can show my wife tonight when I lay in bed. See, I did that for you, honey. So anyway, waiting for the market to show its hand, like tipping its hand to you, was its inability to get the bodies through this area in here. And then once it broke lower, we had that volume imbalance I mentioned right there. Okay. And I just want to show you this. This is what you do when you watch the tape and you're recording your observations in annotations, like you're writing on the chart. I guess you can use market replay if you don't have the ability to see it live, but I can't encourage you more than I'm going to do now by saying having a recording of it live and watching every individual candlestick form and paint. There's really nothing like that, because you're going to be able to see what it's like when it goes up and down in the same candlestick. But this volume imbalance from this high down to, now remember, this is a 15-second candlestick chart. So every one of these candlesticks represents a 15-second interval, which is extremely fast. So if we look at that range from here to here, we're at equilibrium. Above it is what? Premium. There's your volume imbalance. It trades up into it and into that small little fair value gap right there between this and this. So it trades into that, breaks lower, comes up into mean threshold of this candlestick's body in here. That is a bearish order block. It trades lower, breaks below the 2 consecutive up close candles, which is the full bearish order block. The change in the state of delivery is the opening price. It trades up into it once, twice, accelerates after going into that volume imbalance. And if you go back and listen to the recording, you want to see it trade lower. It goes lower. And then you want to see it remain heavy. And then you want to see large, heavy, bold candles rush down there, because they don't want to let the opportunity for the traders that have sell stops resting below that initial low or relative equal lows over here. They don't want them to be able to pull that. So they'll move real quick to get it. So that's how you can time, and that's why you hear me, or see me rather, many times type out in my trade examples when I'm trading live. I'm typing out, I want to see range expansion. I want to see large candles. Heaviness is when the market's likely to drop. Okay. All these things, watching price in better environments is much more rewarding, for the sake of saying, wow, look how fast and sudden it runs. And it's just real easy to see. I picked this week to do this workshop because I want you to see how in difficult market conditions, this stuff still works, but you have to wait. Like you have to wait a lot more than you would if it was in another more conducive climate for precision trading. There's a lot more coloring outside the lines in these types of environments, which, it's still possible. Like, it's still possible to trade in these environments, But my advice to you is don't try to trade in these environments. Learn in them, because the lessons you get from the harder conditions like we're in right now, they will pay in dividends your entire career. Because the things that you see that's being shown in these types of market environments, the heavy manipulation, the long drawn out process before the moves go to a particular level. And when it's between two parameters that would instigate a trade idea, when something transitions to an obvious, okay, now it's having a difficulty to reach up. And then as I was describing, that everything for the session on this particular morning has been jagged. See how it's been up, 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 up. And what was remaining? Smooth. Below here, these two lows, and below these lows here. So what does that mean? Well, look at the real-time commentary I gave you. I literally pointed out the fact that everything was jagged. And then we were having difficulty getting back through this inefficiency. So it's like a barrier. And it's saying, okay, I've showed you my hand. And what do I mean by that? If you look at how, I'll just borrow this. If you look at all this price action, okay, and once we took out this high, this initial high, every time that it went up there, what was happening was smart money was encouraging longs, and they were selling to those longs. Every time a new high was pierced, smart money was adding new short positions, selling here, 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 here. And then in here, that's when I was telling you, okay, I can see it now. When it's between two parameters that would be the reasons for me to take a trade initially, like I would have rather seen 896 swept when it got here, then it would have been an obvious at that moment, I'm going to aim there. At the beginning of the day, I wanted to see that swept and then reach for 896. So you have a plan, you have something that you're going to work with initially, but that can evolve when more information is provided to you. And that's simply just waiting for more information. You got to get at least past that first 30 minutes, because all the order flow that comes in for the day initially, all that is heavily dumped right on the opening, because there's such a rush of buyers and sellers coming in. They will use those buyers and sellers to keep pushing price. They're going to keep offering higher prices. The buying is not sending it up there. They keep offering it higher, 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 and someone's going to be buying it there. Someone's going to be selling it there. There's always going to be some pairing of orders, because they keep sending the price up. They keep offering higher prices. All you have to do is look at a commodity price chart. Okay, look at a commodity price chart and put volume over top of it. Real volume. Price will be rallying the whole time the volume is dropping down. Well, the volume is preceding price. Volume will precede price. It's telling you that there's not more contracts that were traded here. There isn't more contracts up here being traded. It's usually less. So volume would decline when there's heavy distribution. And in your mind, you're thinking there should be more volume, because if they're really selling out, they should be selling with big volume. And it's not always the case. What I like to look for is instances where the market is showing and tipping its hand in a manner where everything keeps pushing up higher. Okay. And I sat and I waited in front of you all. I wanted to see, does it want to take 896? If it takes 896, the first fair value gap would have been this one in here. I would have mentioned that and said, okay, we want to see it now fall from there. But because it did not take 896, and that was the level I wanted to see, I had to sit still and say, okay, we're in between no man's land. Like, I want to see it trade here or here. Which one does first? I could care less. I prefer the sell side first, then run up there. But I have to sit and wait. But over time, how much time? There's 10 o'clock. So the majority of the volume that gets pumped in, all the transactions that are waiting to be thrown into the marketplace at the open, because there's a lot of action that first 30 minutes. There is no significance to the first 15 minutes. Trust me, I'm telling you the truth. There's no reason to worry about that first 15 minutes. That's just a spin. It's the 30 minutes, okay? The first 30 minutes, that is opening range. Algorithmically, institutional trading, everything, they're funneling everything in that first 30 minutes. That doesn't mean there's nothing traded after that. It just means they're trying to force it in there because they have real business need. They're under the gun in terms of they have to portfolio dress, quarterly shifts of assets. They got to move things around because they got to keep their investors thinking they're constantly doing work for them as their fiduciary. So all these things are reasons and catalysts why that first 30 minutes is important. Sometimes you can find setups within that first 30 minutes, but I am never forcing that on myself that I have to find the entry in the first 30 minutes. I'm willing to wait for that first 30 minutes to be done. And you can see just shortly after that first 30 minutes, we get that last little pump above this high. And it failed to take the high that I wanted to see taken. Now, if I have a level that I think is a premium array where it should trade to it, but if it fails, if it can't reach there, what did I teach you about that? If there's a premium array, okay, and it can't get there, or if it's a gap and it can't even get to the halfway point of it and it starts to drop, what is that telling you? What does it signify? What signature is it revealing to you? And how is it useful? It means that it couldn't even get there. So if it can't get there, then that means it's underlyingly weak. So a weak market will do what? It will stagnate or drop. Well, then you got to look at what the condition of the marketplace was doing. It was making jagged runs higher right from the opening after leaving relative equal lows. Kept pressing higher, higher. We couldn't even get the PD right here, and then we broke, and we have a shift in market structure there. I'm not going to trust it yet because it still could run up here one more time. But then when we start seeing this low, take out that one, we have two things now qualifying that this market is predisposed to go lower. But I have to wait for confirmation algorithmically. It has to tell me something algorithmically that it is not going to do something. And if you listen to the commentary I was giving you, what I was saying was that gap right in here, we're likely to see an inability to trade to that buy side because it had no ability to have the bodies close or move outside of that when it was trading up into it here. Let me take this part off here, sorry. See how the bodies were respecting it in here? And then come one more time there and broke. So I said, okay, it's looking heavy. And I showed you reasons and suggestions that we would see it try to expand quickly. We want to see large ranges. We want to see large ranges after that volume imbalance formed and traded off of it, keyed off of it, started breaking lower. Then it went down and tagged it. That price run, that's it. On a day like this, if I was not in front of you, if I was just doing my own thing privately, that's my trade. That's it. I'm done. If I was not in front of you today and I was just doing privately, that would have been recorded and I would have showed you the example. What usually isn't there is me explaining, like I explained to you real time, what was there, what was the catalyst, how we were not being able to go any higher, and everything was jagged on the upside. Look at it. Like it looks like shark teeth, or what is it, a stalagmite or stalagmite, something. When you do cave exploring, the little pointy rocks from the bottom or the surface, not the ceiling of the cave, it's a bunch of that kind of stuff, real pointed and jagged. So everything was being offered higher, so that way they can build in short positions and knock out anyone that was prematurely short. They kept getting knocked out. And then real time in front of you, I told you, now see how we're having a hard time getting out of there. The bodies are just simply having a hard time. And we'll see if it wants to roll over and accelerate. And then I said, watch these. Where's the areas that are smooth? It's these two lows here. And then if it goes below there, we want to see it accelerate, because if it does go below those two lows, they're not going to let these individuals off the hook. They're going to run right for those stops. Okay? And AI does that. Okay? Before electronic trading, there was a group of men, okay, that literally would facilitate this whole function. And they would pair their orders, and that would make the market print those prices. And I don't give a fuck who doesn't believe that. That's just the way it is. That's just the way it is. But it's much more efficient now because we have the advantages of artificial intelligence, electronic trading, algorithmically. Nobody needs to babysit it, but there are times when the market is intervened. There's a manual intervention, and what was going to be ran as a script for the day that makes the high and the low of the day and how it's going to perform. All that stuff's it's all pre-made. It's already determined. There are times though when events happen, or when they institute an event or create one, engineer one, and then they go in and manually manipulate the market. And that is one of the biggest risks in the marketplace, because you can't determine when that's going to occur. You can't determine when it's going to occur. You can't determine, how to protect yourself from it unless you just simply don't trade, which is exactly why I'm not in forex anymore. I'm not going to be trading forex, because we are about to see another big ass event, very similar, if not worse, than the depegging of the Swissy and the euro. I'm telling you, it's coming. And because I don't know when and I don't know how to time that, I am not allowing myself to be subject to that. I'm not going to let it happen. So I've removed myself from it. So I know some of you are pissing your pants right now thinking, shit, I better not be trading forex. You do what you want to do. But to answer the same questions that keep popping up is, why don't you want to trade forex? Because of that. We're getting ready to see a huge financial crisis and major bank collapses and all these things. I said all this stuff 2 years ago in Twitter Spaces. I said it in private mentorship in the first year of mentorship. I said it in lectures before I even did a paid mentorship in 2016, before Trump was even elected. I told you everything you're seeing right now. I told you all this stuff was going to happen. And now we're getting into that. Unfortunately, I'm going to use the word, it's going to be scary for a lot of you, because it's going to be sudden carnage. And I am not opening myself up to that in forex, because it's going to be currency driven, and it's going to bleed into every other asset class. So I reverted back to what I know more. So since we took out the 824 sell side, where is the other side of the liquidity? 896, and we want to see 896, and maybe even pierce up to that 910 3/4. That's an afternoon potential likely candidate. I'm not concerned about it right now, but I just want to kind of like casually go through some other markets to see where we're at, just to get a read on it. I may not talk too much while I'm doing it, because I want to see what they're doing. Before I leave this, I hope you can appreciate how this is ugly price action. Like, this is really ugly price action. And still, even in those environments, we can ferret out what the market's likely to do and how to anticipate timing in terms of speed and magnitude, when it should reach for a specific point of liquidity. In the beginning, while you're learning, the progress and the milestones and the measurements of how well you are developing as a student, you should be doing what I just did today. There's no buttons being pushed. You're giving yourself permission to not know everything initially and wait for more intel. The market will give it to you if you're simply waiting. Wait for it and be ready to receive the intel that it provides you. Everything was jagged. It was just trying too hard to secure a run straight from the opening up, while leaving something so smooth and obvious like that. And they'll never be able to change that. Okay, that's never going to stop working. It's going to always work. That part will always be there, and that's liquidity based. That's the lifeblood of all the markets. So for those of you that are just terrified that they're going to change it because more people are doing it, there's always new people behind those people that have already been here. I mean, think about when you started learning how to trade, or when you got the bug bitten. You just recently started wanting to do it. Like, you're the last one that's ever going to do it. You're the last person that's ever going to want to learn how to trade. No, no. So that's a unreasonable fear. There's no reason to have that, okay? Because there's always going to be this new batch of individuals that don't know what they're doing, and they are liquidity. And you're, well, ICT, the markets don't trade on the heels of the small traders. Your stop loss isn't all that interesting to them. I asked this when I had an interview with Corbs. I asked him point blank. I said, how many contracts does it take to print any fluctuation in change in price? And he looked befuddled for a second. And he's like, one. Right. And that one contract, that one transaction can pierce the high by one tick. And that's the high of the day. And you now go back and say, they're not worried about your stop. They're worried about any opportunity to print that price. That's how they manually did it before artificial intelligence, before it was an algorithmic procedure and process in play. These individuals would look and say, okay, they're literally in a room. They're in a room and they say, look, I'm gonna put an order in at this price. You put the opposing side of it there. And what will that do? It prints that price. That's pairing of orders. Go back and listen to how I taught on baby pips. But now it's much more efficient. Everything's electronic. It's already scripted. It doesn't matter how many people are buying and selling. The levels they want traded to, that's it. That's over. And once they trade there, if you don't understand what those levels are, you're going to keep pushing. You're going to keep using your edge until it's dull and lose money and hair and brain cells and patience and health eventually. So you got to learn how to just sit still and wait for the obvious to make itself known. And if you're not willing to do that, trading's going to be real hard for you. And that's the part I wish I was better at as a mentor, to like fix that stuff, but I'm not. And it's very frustrating. It frustrated me a lot when I was teaching people, in paid mentorship. There's a lot of people I couldn't reach, and I wore it on my sleeve. I was tore up about it. And I did everything I humanly could do, and I couldn't do it. And then you see the other people out there that have much more meteoric success using it. Others that came forward and said, hey, look, it took me a couple years, but I'm here now. And it was worth it. So, it gets to, why are you doing this? Are you doing it for social media clout? Because that ain't going to be enough to keep you in it. Just the short-term adversities is going to put you out of the game with that. And if you're not patient or willing to adopt a more patient mindset, this is going to wear you down. And you're going to have conditions in the marketplace, and we're getting ready to get into real hard ones. Like, we're going to see some real hard market environments. But I'm hoping that we're going to get some really breakneck moves. And that's worth it for me. We're going to see some historic price action this year, okay? And maybe rolling into 2025, maybe the first half of it. But it's going to be nuts, like crazy town. And I just want to make sure that I'm protecting myself. And I've been very transparent as to why I'm not trading forex. It's not that you can't make money with it. You can. But I'm not interested in opening myself up to the measure of risk that I know is looming out there. And I just don't want to get destroyed like a move that occurred with the Euro and Swissy, because it's going to be bigger than that this time. And you're not going to be able to protect yourself. Your stop loss is not going to work. It won't work for you. It will not work. You'll be gapped hundreds or thousands of pips beyond where your stop loss would be. Imagine that. What would that do for you? It would end you. And not to mention, the scar tissue that it would leave. So I'm erring on the side of caution and saying, I'll let all you guys out there that want to trade forex get all that money. I don't care. There's always another market out there. I could be trading coffee and nobody know about it. And that's the only thing I'm doing. You can make money doing that. There's all kinds of markets out there. It's not limited to just forex. It's not limited to just index futures. I showed you cocoa. Cocoa's beating the shit out of Bitcoin, and it didn't take much in terms of margin to get that kind of move or that percentage gain compared to a Bitcoin. So I know I just ruffled a lot of crypto boys' feathers, but I just want you to think. Don't lock yourself into just you started trading crypto when it got popular and you think that's the only thing that makes money. There's a whole lot of other things out there that make a lot of money. And you don't have to worry about it staying in these long, stagnant consolidations like crypto tends to get into. So let me breeze through here. I want to see the Dow. If you look at that mess, that is disgusting. Oh, that is a grenade. That's a date you don't want to go home with. That's somebody you don't want to spend any time with. Good grief. And you wonder why I don't like the Dow. That's it right there. It tells you. Good grief. I just want to take a quick look at the bond market. Yeah, not much going on there. Let's look at gold. You see where the dollar's going? It's probably random too. Let's look at silver. I mentioned coffee. Let's see what the contract looks like now. Cocoa just recently had a nice retracement in there. I did a little bit more today. When I was in the nice runs in the grain markets in the 90s, every time I saw this type of move here, I thought that it was done, and I would go try to trade something else, like hogs or cattle or whatnot, high grade copper. And then all of this, like weeks later, would be gone, and it'd be up like $10,000 more per contract. In the 90s, we had some really awesome runs in the grains. Like they were like corn, soybeans, soybean meal, soybean oil, wheat, oats, canola. Like all those markets, they were like easy. Just get in it and just hold on to it and just let it go. Kind of like your hodler mentality for crypto. It was just, it was wild. Like it was wild. And I really didn't have a clue what the hell I was doing and just got lucky with it. And that kind of win is equivalent to, that's why I kind of like, I can relate to all the people that got into Bitcoin when it was running up. They feel smart. They feel like they're part of a group of people that are just hip. They're in the know. And then it failed and went from 20,000 down to 6,000 and 3,000 something. And I know you want it to be what you believe it to be, but I don't believe that. And I think they're using it's just a Trojan horse, really, is what it is. Let's think of it like that. It's been used to get people warmed up to central bank digital currencies because, well, it's going to be just like your Bitcoin. It's going to be just like your Ripple. It's going to be just like your whatever. When you're not allowed to use that stuff anymore, and they force everything in this expiration date level currency. And yes, you heard that right. Your money's going to have an expiration. If you don't spend it, you lose it. That's not money, folks. That's slavery. So, that's what's coming. Just so you know. The what other markets do I want to look at here? I mentioned high grade copper. That's a nice run from that sell side being taken. And then to give all that back like that. That's what this whole week's going to be like. A whole lot of traversing up and down. And that's why I mentioned that you got to be careful not to try to have a bias. Just trade intraday volatility. If it isn't obvious what it wants to reach for next, don't do anything. Don't trade without a stop loss, because you can see it can really pull back on you. And if you don't have a stop loss, you don't want to discover that that was a mistake after the fact. But I know I said I would do 4 hours today and tomorrow, but I'm really at a point where there's nothing else I could talk about. I mean, we've had something delivered timely based on what I saw at the time, outlining why, and that way it's a little less work to go through today, because we spent more time waiting for the index future. I didn't look at. Let me look at the forex real quick again. What's that? Sell side. Inefficiency breaks. Let's take a look at that on a 30-second chart. Buy side taken. Breaks. Balanced price range. What is a balanced price range? Balanced price range is when you have two inefficiencies in opposing directions in the same general area in terms of price. That's this and this. That range and that range. In other words, it is a fair value gap that could be viewed this way or that way. With one candle right in the middle, that's the better one, because they're going to be sudden, they're going to be more impactful and direct. But it can form where you have this and then a group of candles and then one single pass down that overlaps the previous imbalance. That is typically what they call that an island reversal, if it's a group of candles like that or bars, and there wouldn't be a connection with this candle or that candle. It would be just like this was where it stopped trading the next day. It gapped up here, so there's a real gap, a common gap, not an inefficiency like this where there was actually trading. That's why to say it's a liquidity void is a kind of like a misnomer. There is liquidity. There was trading there. It just doesn't have the sell side delivery, which is given to it here. So an island reversal, and if you have just Google an island reversal pattern. It's a very classic chart pattern. I use that to kind of like describe what a balanced price range is, and then I want to correct the individuals that foolishly talk out their ass and say I renamed something. There are no connective candles or bars in that pattern, but the same logic of how when it goes up and it creates this pause of multiple candles where it just stays in a general area and then finally collapses. See, on an island reversal, when we were just trading open, high, low, close bars, every time I start to do this, I regret starting to do it. All right, so that would look like that. And then you could have something like this. Two, three, four, five, whatever number of candles that are just hanging around up here after a gap. This is like a common gap. In reality, it's a exhaustion gap. Then it gaps down open at a later time, leaves these group of candles or one individual candle. Okay. This gapping formation here, that can't happen in our electronic markets now because they're continuously delivering price. But that same phenomenon is occurring between here and here. Okay, so what I was doing as a trader, I would look for these when they were island reversals like this. After the market had been dropping, and it creates these types of scenarios where there's a gap down. That's an exhaustion gap. That means you're near the end of the move. Then it's down here. It spends time. It doesn't drop anymore. But then suddenly there's a gap up. What I liked to do was I would enter right inside this gap between both of them. You don't see anybody, John Murphy doesn't teach that. Nobody never, ever, ever taught to enter like that. They never did that. And I'm welcoming you to go find it because it's not there. When you listen to people out there say, I renamed something, no. All you have to do is prove it, and nobody's proved it. You get $5 million paid directly to you in a bank check. I'll come to your house and hand it to you. You can live stream it. But all that's bullshit. You got to ask these people to demand proof, and they won't ever have it. But anyway, that same mechanism, that entry pattern here, since I told you I was going to teach you some entry patterns this week. You take the lowest and the highest. Now, the highest is easy because it's only going to be that one candle here. But if there was multiple candles separating the two opposing inefficiencies there, you would use the highest of the low, whichever candle that would be. But when it's just one candle, then it's a dead ringer. It's easy, right? Then you draw this out in time, and you already probably see what I'm ready to talk about. There's your balance price range, nailing it perfectly, and then down. But that's probably just buying and selling pressure, right? Oh shit, that's so good. It's so good, ICT. Oh man, it's so good. Anyway, let's see what the Australian dollar. This shit's all made up. It's contrived. He's making it up. Australian dollar. I'm gonna be honest with you, I don't even miss trading this one. Yeah. Yeah, I think that's what I'm gonna do. We're gonna have an early dismissal today. I'm content with what I've given today. I gave you some insights on reversal patterns, how to factor them as a high probability condition, how to frame it using the dollar index as like an opposing inverted market correlated asset when like you're using with forex. I taught you some things with forex. I covered some things with order flow that can't be taught unless you're looking at, congestion and price like we have here today. I showed you real time how the market will kind of like show its hand to you and how you can anticipate when it's likely to run for a draw on liquidity, how to submit to time, waiting when it doesn't feel comfortable. When you're out here and you're trying to find a setup, learning to sit still and wait and get more information instead of just going out there and recklessly plunging. Feel comfortable and not discouraged because you don't have a clear read on price at any given moment. That's the very times that you will, and probably have, and everybody else wrecks themselves because they're trying to force something. They're impatient. Like, I got time to do something else today if I can get some money. I want to make some money. And you end up, forcing yourself into a trade. Look at that run. There's the sell side outline, and here's the relative equal lows. Watch how it punches through that. There you go. So now look at it. It should be real obvious to you when I was describing how it's jagged. Everything up is jagged. It's like reaching and reaching and reaching. The only thing it's doing is sending orders into this order flow here and clearing the buy side. So all of the guys that want to see this as a liquidity void, oh, it fills it in, now it's going to go down. Wrong. Wrong. And that's why I don't teach like that. That's not what's going on here. But that's the end of the day for me right there. That's completes everything. Like I wouldn't be interested in looking for anything else today. I'd be completely content. I would turn the charts off, go get your fishing pole, go out and catch some fish, get some sun, take a bike ride, do something outdoors, get some grass under your toes and your feet. Me, I'm gonna go grab some soup, and then I'm gonna take my dogs out back and play with them and enjoy the rest of the afternoon. I suggest you do something similar. Relax and enjoy it. Okay. Hopefully you found something insightful today. Hopefully I scratched that itch and gave you something to kind of like bolster some more confidence and encouragement to stick with your study. It's not an easy market right now. So if you feel adversities right now, you're hearing it from a guy that's been doing it for 32 years. It's not easy right now, but there are still opportunities. There's still things that you can do. This stuff still works. But in the hands of a neophyte or a 5-minute trainer wannabe, you're not going to get that level of insight. And I know that gets people all bent out of shape when I talk like that, but I do it for your benefit, not to brag. Because if anybody could teach it better, I would say, you know what, you did a better job teaching. I have no shame in that. Honestly, God's honest truth, if someone was able to teach my content better than me, and you can't because you don't know it all. So that's why I talk the way I do. You don't know everything. How are you going to know all the intricate details and the things that dovetail together nicely to constitute a high probability setup using what I created? You don't know that. You only know what you think you've discovered by me introducing it to you. That's the only thing you got. You got a splash over. That's it. Now the models themselves, they're standalone. Like you don't need anything additional. That's the whole point of having the model. But you have been taught how to trade. You've been taught how to read price action. You've been shown in really crummy market conditions, and it still works. It still works. So hopefully it's an encouragement to you. If you've learned something today, if you had fun learning, even in a slow, drawn-out, murky market conditions, give this live stream a thumbs up. I saw about 12,000 of them or so, or 11,000 yesterday. I think it was 12,000, which, hey, I appreciate that. That's awesome. Trust me, I don't make any more money because of it. It's just a way for you to give me feedback and say, look, I got something from this. So if you learned something today and it helped you increase your understanding about the marketplace and or inspired you to study more, that was the goal. That was the aim. And that's why I'm here to do it. I want to see you do well, and I want to see you kill it. So until I talk to you tomorrow, Lord willing, at 8 o'clock, be safe.